Welcome to our series on creative financing, where we discuss buying investment real estate using other people's money. Today, we're going to talk about the investor mindset and the thought process that a successful real estate investor goes through when they're looking at buying a property. To understand creative financing, we first have to understand conventional financing. Typically, most people go to the bank or a mortgage broker and they apply for a mortgage. The lender agrees to give them a mortgage of 80% of the purchase price, and they have to come up with a 20% down payment, their legal fees, and their land transfer tax. Or they pay an insurance company like CMHC a fee so that the bank will lend them more money and so that they only have to come up with a 5 or 10% down payment. Creative financing takes the thinking to the next level. Every seller has a problem. If not, they wouldn't be selling the property. Our goal is to understand the problem and propose a solution that meets the seller's needs and makes us both whole. We are looking for win-win situations here. Understand, as real estate investors, we are problem solvers. We solve other people's problems. Now, the solution may involve conventional financing, but invariably it's going to involve using other people's money, or OPM as we call it, often to 100% financing or more of the purchase price. So let's look at an example. What we're looking at are the numbers for a flip or a buy, fix, and sell. We've found a property and we've gone to the bank. And the bank has agreed to give us a loan of 80% loan to purchase price. They want 20% down. We've asked for a fully open mortgage. We anticipate the renovations are going to take about 6 months, and we want to be able to pay off the mortgage without penalty when we're done the work and sell the property. We're looking at a 4% interest mortgage with a 25-year amortization, so our holding costs are going to be $5,400. Our repair costs, we brought in a contractor, and they've given us an estimate of $25,000. We know we're going to have legal fees and land transfer tax of about $3,500. When we come to sell the property after we've done the repairs, we're going to be looking at $16,000. We want a minimum profit of $30,000 and a contingency fee built in of $5,000 just as a buffer in case we run into some cost overruns. We're looking to rent the garage in the back for $50 a month to make a little bit of income while we're working. We take those costs and we take them off the end value of the property. We're looking at the ARV, or after repair value, of $300,000. So that means that the maximum that we're willing to pay for the property is $216,300. And it means we have to come up with a down payment of $43,260. So all in, we're out of pocket $77,160 to make this deal happen. From an ROI perspective, that's a pretty good 77.76%, calculated as our $30,000 minimum profit divided by our money in the deal of $77,160. And because we're going to do this in 6 months annualized, we multiply by 2. And that's how we got the 77.76. Next, we go to the vendor and we talk to them about the challenges of actually buying their property and doing the repairs and selling it. And we let them know that we're not going to have any income while we're doing this. And we ask them whether they'd be willing to do an agreement for sale, which is really a type of long closing where you get control of the property and you can do work on the property while the vendor still owns it. It's a type of vendor financing. So we're looking at a 6-month term, and the vendor has agreed to do it as long as we pay them 8% interest with monthly interest-only payments. So what this means is our repair costs have not changed, still $25,000. Our purchase costs have not changed, still $3,500. But our holding costs have gone from $5,400 to $8,700. What that also means is that as part of the negotiations, we're now willing to pay $213,000 for the property. But we no longer have a down payment. So out of pocket, we're now only out $37,200 in order to buy this property. What does that do to our ROI? Well, we go from 77% to 161%. Pretty awesome. The next step is to talk to the vendor about our financing needs over the course of the project. And we let them know that, we have no income while we're working on the project. And there's no revenue coming in. So we asked them whether they'd be okay, instead of monthly payments, whether they'd do an interest only balloon payment at the end. They still make the same money, but instead of monthly, we're going to give them the payment at the end. And what that means for us is we don't need that money out of pocket during the renovations. That becomes a deferred expense that will be paid from the proceeds of the sale. So the repair costs are still $25,000. The purchase costs are still $3,500. The holding costs are now zero, but we have a deferred expense of $8,700. We're out of pocket only $28,500 to make this deal happen now. And our ROI has gone to 210%. But we're not done yet. We still have all the issues with the repair costs. Next thing we do is go to one of the big box hardware and lumber stores and we open a commercial account. When you purchase large volumes of material on commercial accounts, they generally are willing to give you 6 months to 3 years of interest-free financing on the materials. Sometimes they require monthly payments, sometimes not. But in this case, we're going to get interest-free financing for the 6 months on $15,000 in materials. What this means is that our repair costs have now dropped to labor only, and they're $10,000. Our purchase costs haven't changed. Our holding costs are still zero, but our deferred expenses on the sale have jumped to $23,700. But we're only out of pocket $13,500 in order to make the deal happen. What does this mean to our ROI? Well, we've now gone to 444%. But we're not done yet. Now we go and we talk to our contractor. And we look at them and we talk to them about the deal and the income and expenses during the deal. And we ask them whether they'd be willing to take payment for their work at the end, as opposed to ongoing during the project. And they agree and accept a deal that would pay them 1/4 of the net profit instead of a cash payment along the way. What this means for our numbers is that our repair costs have now dropped to zero. Our immediate repair costs. We still have repair costs. Our purchase costs are still $3,500. We have no holding costs. But on our minimum profit, we've added another $10,000 to cover what we're going to have to pay the contractor. And it means that our deferred expenses until the sale have climbed to $33,700. But we're only out of pocket $3,500 to make this deal happen. So what does that do to our ROI? We've now jumped to 1,714%. But we're not done yet. The last cost here are our purchase costs. We have $3,500 in legal fees and land transfer tax. Now, most lawyers are going to be looking for either a credit card or they're going to be looking for a certified check or some form of equivalent to cash payment on closing. You can take it and you can put it on a credit card, or you can use a balance transfer card and do a withdrawal from the card. Typically, you're going to be charged a 2% balance transfer fee, and you will get somewhere between 6 months and a year of interest-free time for that money. So that means our $3,500 in legal fees and land transfer tax is getting moved to the deferred expenses on the sale, and we're now out of pocket only $70 to make this transaction happen. What does this do to our ROI? Well, we're now equivalent to a 100% finance deal, and our ROI has jumped to 85,700%. So let's review this. By the time we were done, this deal was 100% finance, including all costs, with a combination of agreement for sale a balloon payment, store credit account, profit sharing, a credit card, and a balance transfer card. In all cases, the purchaser made his $30,000, but by the end, they never had to qualify for a mortgage and they never had their credit checked. This is the same deal, the same transaction from start to finish, except in one case, you had to put $43,000 into the deal, and in the other case, you're 100% financed. It's a mindset game. It's a thought process. Creative financing is about thinking differently. It's about looking for creative solutions once you understand the problem. It's about thinking outside the box. That said, you have to have the courage to ask for what you want. This only happens when you ask. If you don't ask, the answer is always no.